My name is Amber Knapp. I am the Global Relationship Manager at Global Corporate Venturing. And we're here today to talk about corporate venturing, what that looks like, and how to engage, best practices. And so I'd like to start by just introducing our panel here. John, Sunid, and I'm so sorry. And Caitlin, I'm so sorry. And we'll learn a little bit more about them in just a moment. But first, I just want to see, by show of hands, how many corporate investors do we already have here? Okay, a couple. And VCs? Great. And then do we have anybody here that's fundraising? Any startups? Excellent. All right. Well, maybe we'll start with you, John. Would you be willing to tell us a little bit more about yourself? And then we'll just go right down the line.
Sure. John Pavlitic. I lead the tech investing strategy as part of Lilly Ventures. We invest off of Lilly's balance sheet. We have a large fund of both fund of funds as well as direct equity investments. My background started with Lilly about 5 years ago. If you guys know anything about Lilly, that means I'll be new for at least the next decade. And started out in the digital health group, doing early stage product strategy, moved over to the ventures team in late 21. And before that was with Abbott Labs for a dozen years across a number of different verticals in sales, marketing, and strategy.
Hello. Sunit Jani. I run Eaton's corporate venture practice. We invest at the intersection of energy and mobility, which basically is everything. And I've been there for about 2 years. Before that, I was with 3M as part of their venture capital practice. Happy to answer any questions and hope to have you guys ask us a lot of interesting questions.
Hey everybody, my name is Caitlin Foley. I'm the president of Up Labs. We are a unique approach to CVC. So we partner with established corporations to launch new companies together. And I've actually been in this very specific space of launching small companies with big companies for a decade. First at the Boston Consulting Group's Digital Ventures, where I was a partner. We are 2.5 years old as Up Labs, and we're already partnered with Porsche and Alaska Airlines. So I'll talk more about our model and the 10 companies that we've launched thus far. And I'm based in San Francisco.
Great, thank you guys. And so just kind of getting right into it, Sunid, I'm wondering if you can just tell us a little bit about your experience in working with CVC. What does that looked like for you throughout your career?
Yeah, so working within a CVC, I think there's a certain advantage that corporations have in terms of the bench of talent and the depth of expertise that we have within markets and customers. And so we're always thinking about what it means to plan for the future and how we can invest and partner with startups to do something interesting. And I think if you can plan that appropriately to make it mutually beneficial, you can start seeing outsized value both for the startup and for the corporation. I think one thing that is much harder for larger corporations to do is to start smaller endeavors within the organization that are new for us to do. So anything that's new is hard because it's when you have to expand your business paradigm and build it from scratch, it's a muscle that we often haven't built. And so the CVC is a vehicle for large corporates to learn about the future and to partner with companies that are actually building out new businesses and potentially accelerate that and make it something that's scalable.
Great. John, can you tell us how you've seen success in CVC?
Yeah, I think maybe one thing to touch on is just what success means. So as far as corporate venture investors, if you go and talk to a handful of them, and actually I would be willing to bet between Sunit and I, we probably have different mandates within our funds in terms of what success looks like, but it can go on a spectrum of purely financial, where you are investing just like an institutional investor, you care only about return on your capital, and then you've got, on the other side of the spectrum, purely strategic. There is a statement that losing money is not strategic, so in general, even strategic investors like us do care about financial returns, but I think as you think about fundraising from other strategics, as you think about co-investing with them, it is important to understand what their mandate is, what their strategy is, and kind of how that plays into their behaviors. For us, what success looks like is we think about the tech investing strategy. That really looks like pilots and other pull-through from a value perspective with business units and functional areas within our groups. And so while we try to invest with a 3 to 7 year horizon, we do look for those things that can have a quick flash to bang in terms of maybe they're just ready for a pilot right now versus enterprise-wide deployment, or within a certain disease state, within a certain geography. But that's really how we think about success on our side. And then on the therapeutic side, in terms of the biotech investments we make, it's really about how can we get new assets into our pipeline.
Well, to your point, John, Sunid, can you maybe share how does success look the same or different for you and for Eaton?
Yeah, so agree that every CVC will be different in its own snowflake. The success for Eaton specifically is about acceleration. And this can be path to market, this can be technology acceleration, this can also be acceleration internal within our organization. As an example, the automation of our manufacturing plants, thinking about supply chain integration, et cetera. So I think anytime that we can accelerate and speed up time, because time is the one asset that like everybody has the same amount of, we're really interested in figuring out how to do that. And if we can actually accelerate time in some sort of tangible manner, that's how we generate the strategic returns. And then I think, John, you're right. We then have to do a full financial diligence on the company before we were to invest, because losing money is never a good strategy.
Caitlin, I'm curious to hear from you. UpLabs has a different approach, and so I'd be interested to hear what that looks like.
Yeah, let me just walk through our approach. So we work with a large company, and unfortunately today, large companies sit there and they have a bucket of problems. And some of those problems you sprinkle on the R&D team, and some of them you sprinkle on your accelerator or incubator, and some of them you go to your corp dev team, you acquire someone, or you invest in a startup. Those are really the 4 main ways that you can approach innovation today. We are a 5th and complementary tool. So we lean towards strategic value, but we take the problems that are still sitting in the bucket at the end of the day, and we try to tackle those. And we develop a brand new company around them, and we hire a founder/CEO to come on board and run that for us. And so that process takes us about 12 months. That's the first year. And then we're in a partnership with a venture fund, Up Partners, who funds the seed round for this company, and that's typically a $5 million seed round. So that company that goes out into the world needs to work with our corporate partner. They need to solve the problem that we were looking to solve. And they need to generate a ton of value. So we do lean towards strategic, not market value. We try to tackle $20 to $100 million problems in the first year alone, and then we go out and expand into the broader market.
Interesting. I think I want to just stop here if it's okay. This is off script a little bit, but does anybody have questions about the model or about their CVC experience so far before we move forward? Okay. So then I'm curious for the role of CVCs. John, in your view, what's the role and the value of the CVC to the startup?
So in terms of the value to the startup, effectively, once we close on an investment, we like to say that we turn into an internal sales rep for our startup. So our goal ultimately is value pull-through. And so that looks like trying to find functional leaders, trying to find business unit leaders that would be interested in this company. Typically, we're not making an investment in a company that isn't already familiar with or familiar to some of the leaders across our organization, even if that's just an introductory kind of demo that we've had them do in order to understand where we feel like there might be some alignment. So that's really where we focus a lot of our energy. I can give you an example. We've made 9 investments since the beginning of last year, and in terms of the different criteria and different sectors that we're trying to invest in, we've hit a lot of those already. So we're really turning our efforts now into, all right, how do we actually cultivate the value? How do we put together portfolio days, demo days, things like that to really pull through that value within the organization?
Is there any differences for you, Caitlin, in your approach to this?
We're really focused on strategic value from the get-go and making sure that there's alignment with the core strategic objectives of the corporation. And so what that means is we actually set up our own investment committee, much like a CVC has, and that's made up of executives from the corporate partner, our fund, because remember they have to fund this idea, and then our team who's coming up with the concepts, and we're really pitching, from the get-go. And we also have about 10 companies in our portfolio as well across 3 different corporate partners.
Any thoughts on this from you, Sneed?
I think the advantage that a startup can take from a CVC is very quickly understanding what not to do, because we just have a lot more experience in industry technology, channel, like how to go to market, than maybe you do. And so I think leveraging the corporate to your advantage as a founder is really important. You also have to understand that we will move a little slower than you do, and you have to come to grips with that. We have generally a larger brand to protect and more processes in place. People are doing a lot of different things. So as long as you can kind of go at our deliberate pace a little bit, you'll actually, I think, extract value if you look for it. If you're looking for the quick hit and hey, we're gonna scale with a corporate immediately, and that's gonna, I would advise you not to do that. Like, it won't work. You just have to go through the proper channels and process to get things done in a corporation. So go at our pace, leverage our capabilities, and I think you'll do a lot of learning and figure out what not to do.
Caitlin, because you do have a different model, curious, what does your relationship with the corporate parent look like?
It's really close-knit in nature because we're coming in, remember, and architecting a 3-year partnership with every corporate partner that we work with. And we launched 6 companies, so it's a full portfolio approach. And so that investment committee kicks off from the very beginning, and we take problems we're solving, problems out of that bucket, and go and try to solve those with brand new companies that we're launching together. And sometimes it is slow, but that investment committee helps us speed up. And so we actually get a ton of data access from the beginning. So for Porsche, we had all telematics data coming off of the Taycan from the beginning. This was an absolute game changer in being able to launch our first set of companies. So the data piece is a really important component.
And for anybody who's interested in answering, what's the long-term strategy?
All right, in terms of the long-term strategy, ultimately our goal is to help Lilly see around the corner in terms of the technical innovation that's going on out there in healthcare. We have 2 investment themes we invest under, Next Gen Pharma, which is what it sounds like. How can we just help Lilly do what it's done historically, just better, faster, and less expensively? And then on the other side, we have Healthcare 2040, which is really around what does the evolving care delivery ecosystem look like, and how does that continue to change along with patient expectations. So as we think about the long-term strategy, I think we'll continue to evolve in terms of the new types of technologies that are out there, but the long-term goal ultimately is to enable Lilly's long-term vision and frankly try to de-risk that.
So I'll go a slightly different, take a slightly different perspective. I think it's actually about enabling culture change within the organization, because we're doing something and working with folks that don't do the same things that we do every day. And I think that if you're any large company, you get into this rut of doing the same thing with slightly incrementally better every year. And that's where we think that the culture and leadership around startups and bringing new ideas and doing things that are hard, putting that into the organization with those partnerships is really important. So I think like longer term strategy, absolutely want to get technical trends. We want to figure out how the markets are going to change, but we actually want to enact culture change within the organization and then allow options, right? So we're really making bets on options into the future. And that's different than saying we're going to fully dive into a particular business. We can actually maybe dive halfway into 4 different businesses that all solve the same problems. So that optionality and like culture change is really important from a long-term strategy perspective, because that's a thing that'll actually stay. You'll have good years, you'll have bad years with investments, you'll have some businesses that won't grow and don't work, and like you have to deal with that volatility. But if you can continue to enable culture change within the organization, you'll have staying power within the team.
And from our perspective, we're looking for digital transformation and shareholder returns. So like, let's take Porsche. as an example, they're moving into the EV space. So that's an enormous transition for a company like that from, the 50s. And so we've helped them by launching several startups, which frankly they could not have launched on their own, and also they could not have invested in because these companies didn't exist, and we didn't have proper competitors when we started this company. We're catapulting them into the next century of their growth. And I think the culture piece, like Sunit said, is a really big component of this, and helping them think like a data science company, make decisions differently than they're making those decisions today.
If I might just add one piece to that, just around the culture. Of course, there's the innovator's dilemma that everybody's heard about, but I think another piece is most people go to a large corporation to help it be what it is, rather than transform it and have a little paranoia around what the future looks like and how do you stay ahead of that. And so I think that CVCs can actually help with that. We're very fortunate that we get paid to think about the future. And I think that that's something that, to Sunit and Caitlin's point, can kind of carry across the organization.
It's a great segue into my next question, because I'm curious, what do you, Sunit, you and I were talking about this before our panel. What do you think the future of CVC is, and how has it shifted? I've seen shifts just in the last few years for sure that we were talking about. So what do you see in the shift and where it's going?
Do you want to take that first?
Yeah, so corporations have, I think, come to grips with the fact that innovation is difficult within the framework in which they exist. And if you think about partnering, investing, building businesses, all as tools in that toolkit, CVC is becoming more and more mainstream, and has over the past decade, if you will. I think the future is actually more domain-specific venture capital groups that are actually driven by corporations. And I think there's an inherent advantage, right? If I want to invest in pharma, do not have the bench of talent that John does to evaluate pharma technologies. So why would I have any advantage in that scenario? So if you think about an institutional VC, the advantage there is access to knowledge. And I think corporations have access to knowledge that institutional VCs don't have. So moving forward, as the comfort around CVC becomes more and more mainstream, why can't corporates be the actual investment vehicle for our own customers to invest in for things that are not core to them but impact their business every day, where we have the expertise and they don't, but they need that expertise to enable their own business. So I think that's one area where I think the future of CVC can go. And then I think the other big part of this is that we're going to have to move to taking more and more smaller and earlier bets and having more and more of these fail to truly innovate and look around corners. And I think that's the other piece that we're becoming more and more comfortable with as CVCs become mainstream within the organization. We're explaining to the powers that be that, hey, 7 out of 10 companies fail. And so if we're going to be launching businesses, not every single one of them are going to be successful. And as that risk tolerance moves up, we'll actually get larger outcomes within corporations because we're more tolerant of risk.
Yeah, candidly, I haven't been in the CVC space long enough to have a sense of where the market's going to go and how it's going to continue to change. I have to think it'll continue to professionalize and have similar goals as institutional investors. What I can actually say is within Lilly, our hope is that we turn Lilly Ventures more and more into a place that the top talent in the company wants to come, grow, and then go and excel in other parts of the organization. Frankly, we kind of considered ourselves the best kept secret in Lilly. People didn't really know what we do. It's a very kind of niche space, but we want to make sure that we attract the top talent regardless of background, and make sure that even if somebody doesn't want to come here and spend 5-10 years, that we have the ability to grow them and make them the best leader they can be for the rest of the organization.
And I think we're going to see more of a leaning towards strategic, not market value, because if you think about it, for a large public company, trying to bet on unicorns every day is a terrible way to make money. I wouldn't want to invest in that company myself. It's really about unlocking strategic value, because that's where the dollars are. So that would be, my thought there.
Yeah, well, and I think that it's really hard when you cross-pollinate between industries. As an example, Eaton has a vehicle group and we have a power electronics group. Well, both of those groups are relevant in the EV world. And you can't think about things like vehicle to home without considering the utility, without considering the homeowner, without considering the buildings. And historically, these verticals have all been isolated. And I think that as you cross these streams across customer sets and technologies, that's where you get the most innovation capability and opportunity, I would say. But you also have, it's the hardest one to do because you have to do stakeholder analysis and sell across a lot of different things now. So I think like the corporations with their access to all these customers have an inherent advantage in delivering strategic value because we can actually see the markets across and the strategic value across several markets for certain capabilities versus just one at a time. And I think that's an inherent value and advantage that corporates have.
Sunit, I also agree with you on going earlier stage. We're seeing that as well because if you think the asset here that the corporate has, so data, but also an understanding of what their problems are, and they know that from the outset and they can go solve those right away without waiting for a startup out in Silicon Valley to come up with something because that's a highly reactive measure to take every single time they want to invest.
So looking back, we've kind of shared some successes, but looking back at CVC, Sunit, what are some obstacles that you've seen that have been overcome or some mistakes that have been made?
Yeah, so startups aren't established companies, and so I think you start with this idea that corporations are pretty good at evaluating existing, long-standing, established companies. And so you have to start with that mindset and figure out how you adjust that to working with and investing in and partnering with startups. So I think that's one obstacle that we have to overcome. It's not just about speed, but it's about expectations. Hey, this company of 7 people doesn't have a QA team. Of course not, they're 7 people, right? Like they don't have a QA team, it's okay. So what's that risk tolerance? I think risk is one. I think expectations from the startup is another one. And then we have so much to protect as a corporate. We want to protect all of it moving forward. And I think that's another thing that we have to overcome is that we can't limit the founder's dream of being a billionaire, right? If everybody who founds a company, we have to support their dream of being a billionaire, and that means we can't restrict that company from growth. And so I think that's some of the obstacles that you have to overcome. I think, though, that the professionalism of CVCs has already started to occur. I mean, I think we've grown up, and more things like if you expect something like a ROFR from a startup, like this is not market anymore, and they're just not going to let you in. And there's enough other folks out there that are willing to put capital in that you'll get boxed out of that. So there's natural repercussions to being a bad partner. The last thing that I'll say is that it's not a transaction. So I think that's the other thing we have to teach, is that an investment into a company is not a transaction. It's actually, you're building a relationship with the CEO, you're building a relationship with the investment partners that are also investing with you, and then you're building a relationship with that company. And those are 3 very important relationships that all matter, and you have to maintain that relationship moving forward, because that's what you're actually doing, is you're building that relationship and not transacting with the company.
Yeah, I would say one of the things that's trickiest as a corporate investor is just managing stakeholders that are typically levels above you and have budget, have cachet, at least within the organization. And I think that's something that just takes a little time. And I think that's where it's important as an investor to be able to have as objective as a stance as possible in terms of why you invest in what you invest in, because there are going to be any number of executives that come to you with, hey, this company looks great, why don't we invest in them? And then you dig in a little bit and you say, well, they actually don't have any employees, everyone's a consultant, and their slides were full of just screenshots of what they think an app might look like. So I think that's something that does take a little getting used to, and can be career limiting depending on how the organization operates.
And it's definitely career limiting to say no to the first deal that they bring forward, but you absolutely should do it. You should absolutely
100%.
do it. It doesn't even matter how great the company is. Just say no. It's like, it's a stupid company. We're not going to invest.
I don't know about that, but
And the reason is that, like, I think if you have a framework in place for like why you invest and what are some core metrics that you use, the beauty of VC is there's always a reason to kill a deal. Like, I mean, you can always find a reason, but knowing that not all companies are investable entities is a hard lesson. It's a hard lesson to teach, and so. You like take the time to like build out a framework. I'm sure, Caitlin, when you like start a company, there's like the market size has to be blank, the growth rate has to be blank. Like, so have those metrics in mind beforehand. And if you don't know what they are, like ask around. I learned so much from other CVCs who had already been in the industry before when I started, and asked all the dumb questions. There's no such thing. Just go out, make a network, ask the questions. You'll get a framework for like what is an investable entity, and then use that to your advantage and say, this all looks good, but these things don't actually fit. And so if we invest, it's actually more risky than otherwise. And that's how you're going to build that risk profile out. And it's a hard thing to do within an organization, especially if you're new to that organization. So find a friend in the organization who knows who the people are that are going to tolerate the risk and who are going to allow you to kind of learn as you go, because I think it's really important.
My perspective is a little bit more from the startup lens, but you got to go in understanding the problem you are solving. I'll say that again, understand the problem you're solving, because that's going to find the friend who's going to pay for it ultimately. And what you don't want is to get stuck in POC hell, because I've been there. So you want a commercial relationship with the corporation as soon as you possibly can get started with that.
yeah, I think maybe just building on that, I think from the startup perspective, what's important is investors, to Sunit's point, are going to try to find any opportunity to kill a deal, right? I mean, you want to have as low a percent of companies that you're investing in compared to what you've seen as possible. But you also want to find great companies that are out there. And I think being aware of how investors assess risk within a startup can be really helpful. And I think being honest about where you are in that process is also helpful, because nothing in the world is perfect, right? My idea of a perfect dinner is going to be different than Caitlin's, is different than Sneed's, although I don't think kids are involved in any of them, so that'll probably be common. But I do think just being honest about that, because as investors, we're looking for those disconnects between audio and video, and if I get a sense that I'm being misled or there's something that even feels a little bit off, I think trust is the main thing that you need to be able to have going forward. And I so think just being honest about, hey, this is where we are. We know that we have these things to build on, and looking at investors as collaborators to help you get to those next inflection points, I think can be valuable.
I will say too that as you're talking to corporates, really listen to the questions that the team is asking. Because if they take you down a path that you weren't expecting, they're not doing it, especially when you get an audience which is with a broader corporate team, they're definitely thinking about something that you probably haven't thought about. And so really ask the questions of them, like, why do you think that's important? Like, where are you going? Because there's times where you know the problem you're solving, and then there's times where you could be solving a totally different problem that's more important. And so, like, we often give ourselves away by the questions that we ask. So, like, really listen and like probe. It's a two-way interview, right? You want to, as a startup, you get to pick the investors in your company, and it's a really big deal, and it's just something you shouldn't give away for free. So, pick a really good partner when you pick an investor, and so it's a two-way interview, and use it to your advantage.
You all have already given really great advice, but I think I'm going to ask for a little bit more. Just in working with CVCs, is there maybe one other tidbit of advice that you would give to startups who are looking to engage specifically with CVCs?
I think this is just general, but I've had a number of calls where a founder will spend, of a 30-minute call, they'll spend 27 minutes on intros and then kind of question and answer and all of that, and then they'll leave the last 3 minutes to, oh, I am fundraising, are you interested? I think that, the signal I get from that is that time management is poor, because frankly, I want to see how the founder operates in that environment, and frankly, that's going to be a proxy, at least for me, on how they're going to manage that type of conversation with a customer as well, or a prospective customer. So I think really just it's the fundamentals of just time management, making sure that you're organized. And again, this is all anchored on kind of that first pitch conversation, but I think that can be really helpful.
I think having your pitch deck sent out in advance that tells a story is really important. We probably talk to half of the pitch decks that we receive, and we receive a pitch deck from maybe half of the people that ask us for a meeting. And so we're already only talking to 25% of the inbound interest that we get. And so if I can't read your deck, if your deck is 95 pages, not interested, right? Like, you know the problem. Why are you solving the problem? Who else is solving the problem? Why is yours better? And what do you want out of the meeting? Like, it's got to be really crisp. And then, yeah, don't waste time, because like time is, again, it's the one currency everybody has the same amount of, and everybody within corporates is now really busy. So if they're taking time out, that means they're really interested. So maximize the utility of that time.
I think it's also really important to align your KPIs with those of the corporation at multiple levels. So transactional KPIs all the way up to the vision that the leadership team is taking for that company, and to communicate that across different levels of the organization. One thing that has been really shocking to me in working with large companies is the executive teams generally know about 4% of the problems at a company. So they're more thematic at that point. It's not specific problems that they understand. And it's really the working team level folks that understand those problems in detail. So you have got to work with folks out in the field, their managers, all the way up to their managers to be successful here. All those levels come together. And one of them is going to pay for your product. You have to figure out which level that is as well. Who's the P&L owner very, very quickly.
One other thing to consider is, do you even need to take venture capital? There are tons of great businesses in the U.S. and globally that never took $1 of venture capital. They're profitable, they employ a lot of people, they either change the world or they just help keep buildings clean, whatever it might be. I think it's really important to think about that, because you can get stuck in the trap that, had you not taken VC money, you could have had maybe a smaller business, and maybe you wouldn't have put the dent in the universe that you thought you were going to, but you'd still be profitable and successful. But as soon as you take in outside money, you have to account for other people's goals and how they're trying to return their fund, and so that changes the motivations of folks that you have involved in your governance. And that's not to say that VC is bad money by any means. I think it's just you need to be really clear about, do you need that, or are there other ways you can fund your company?
And I think the simple math behind it is also, if you want to be bought for $1 billion in 5 years, and you're going to own 5% of the company, or you want to get bought for $10 million in 15 years and own 90% of the company, your NPV on that, those two metrics are the same. Like, the net present value of that capital is the same. So really think about what you want to do. Take VC money if you want to scale fast, get diluted, and then potentially fail, or systematically build a business with strong unit economics over a longer period of time. As a founder, if one goal is to maximize your outcome, oftentimes the longer, less dilutive way and really figuring it out will actually yield you the most return.
It's also a lot harder to get acquired if you're not profitable, because a corporation uses their balance sheet to acquire you, but they don't want to take a hit to their P&L. Why would they do that? So we actually promote profitability as well. And I'm proud to say, out of our portfolio of 10 very young 6 to 12-month-old companies, we have one company that is profitable today. And we took that path. I know, yeah.
Well, and when you talk to a company, just do real simple financial analysis. Just go to finance.google.com and look up what their ratios are. So if you understand that for every $1 of revenue that Lilly makes, their market cap is worth $7, and then their earnings per share is blank, and if you can't deliver that, the minute that they buy you, they're losing market cap. So why am I going to make that decision unless I really have a strong synergy to take you somewhere where you're not today? So if you're going to be a net loss initially from an acquisition perspective, there has to be a really good story for John to take you forward and say, we want to buy you, we're going to get a hit on market cap, but in 2 years we're going to make it all back. That's much harder than saying, we're going to buy them and immediately get an accretive hit on our market cap. And these are the these are the kinds of discussions that we have at that corp dev meeting.
Okay, so kind of flipping the question on its head, what advice would you give? We can start with you, Caitlin. What advice would you give to a CVC that's just starting out, or to somebody who's just starting out in CVC?
Focus on strategic value. Find things out in the market that are a great fit, that deliver that shareholder return and increase market cap inside your organization. Make friends with people who have the problems, who are going to take those companies in and work with them, because sometimes we notice disconnects between CVCs and the business lines. And that's also a really important relationship for you to build, because they're going to create the strategic value for you, and they're going to help you do diligence on the investments that you want to make.
It's a people business. Get to know the people. You will not be able to be successful if you just talk to companies and if you just try to figure out technologies. Like, you have to understand who's investing, why they're investing, what else they're curious about, where they get information, and like, information is one of the main currencies in the industry.
Yeah, I think building on those great points from Sunit and Caitlin, I think it's just take every call, whether it's from a founder or internally. Just try to talk to as many people as you can, just to orient yourself and figure out which way is up, and try to figure out how you can match those problems, which I'm a massive believer in, with what's out there in the market.
Yeah. So when I talk about how we only take 25% of like calls that come in, for anyone who's new on our team, they take all the calls. Like, in your first year, you should talk to 1,000 founders, like just 3 a day, knock them out. Like, it's all about reps, so you have to get reps.
It's been really good, guys. Thank you so much for talking through this, and I'm going to open it up again for questions. Does anybody have a question for one of the panelists? We've got a couple.
Sure, go ahead.
Oh, we've got a mic. Will it work
This question's
fine?
for Sunid. You were talking about investing in companies to start culture change within the organization, and that would involve investing into 4 companies instead of maybe investing into 1. What do you do if the culture at the company that you invest in does not match the culture that you're looking for, the culture change that you're looking for, and how do you offload those companies?
Yeah. So the culture in the corporation will almost never match the culture of the startup. They won't. They're 2 completely different. I'll use a sports analogy. Just because baseball and cricket are played with a bat doesn't mean they're the same sport or they're even close, right? So I think it's more about incremental change as you go forward. So if you invest in companies, the interaction between that company and your company will enable the change, and they're going to start thinking differently as you go. So it's a play on time, not necessarily immediately. And then I think the question about offloading companies, right? So VC, it's an illiquid market. You can't just offload something. You know, if you buy stock in Eaton and you don't like what we're doing tomorrow, you just go and you sell it on, whatever. The secondary market's a lot harder in venture capital, which is why I think having really good fundamentals on investment theses and metrics around making sure we don't lose money is important, because even though some things are strategic in year 1, the same things aren't going to be strategic in year 4, potentially. Some may not. And so you will have orphans in your portfolio that are no longer strategic to your company. So if they don't have sound unit economics and an investment return capability, you're going to end up in a bad spot. So I don't think you should ever view it as, how do I invest, do something, and then try to offload. I think it's an invest and hold strategy with really sound companies that can enable change incrementally in your corporation that are strategic at the time of investment, and then hoping that many of those ones are still strategic later when the companies are ready, right? So you're talking a 5 to 7 year period of holding it, maybe longer if you're in pharma, depending on timelines, right? enterprise software might be faster. So it just depends. But if you're hardware, if you're pharma, you're med tech, depending on how early you go, you have to think about holding these companies for a while. And there's a lot of risk associated with them not making it. So you have to kind of believe that the unit economics are there.
Can you guys give more specific examples of how you have seen CVCs support their portfolio companies? Is it like, are they making introductions? Is it strategic partnerships, lunch and learns? Like, what do those look like?
Yeah, great question. So I think there's support you can provide within the corporation. And so, yeah, it's making introductions, being part of workshops to make sure that the value that the startup is trying to communicate to the internal folks and what the internal folks are trying to communicate to startup folks kind of aligns. We're putting together a portfolio day later this year where we're having 8 or 9 of our CEOs come in and meet with a number of executives at Lilly and kind of a half day kind of show and tell. And then, so that's all internally. And then externally, it's how do you advocate for that company out in the market? So what other investors can you put them in touch with? What sort of, are there other corporates you can help them with? Are there startups that you see or technologies you see that you can offer to them and put them in touch with?
Yeah, I think commercial engagement is important. So if you want to talk to Toyota and it's hard for you to get in, Eaton probably knows somebody at Toyota and we can enable that conversation. That's kind of one side of it. I think being a customer of the startup is really important. If it's a problem that we have and we're a customer of that company, and then they can use that as a case study to kind of scale up, like that's another interesting piece. There are harder ones around development and building new products because you're going to get IP and then lawyers get involved, and that's just a little bit harder to do some of those. I also think that the internal part's important because you need buy-in inside, but the ways that you can kind of partner with those companies and scale them are equally interesting. But then even like simple things like, hey, we're thinking about manufacturing this blank, blank, blank. Like, how do you do that? And well, we have a lot of experience in manufacturing, so we can help there. So the more interaction that exists between the startup and the corporate, the more value that the startup will get. And then to answer that first question, that the more interaction then means there's more culture coming in to our way. So like you have to have that business buy-in to enable that. And I think one thing that some successful folks have done is have a specific team that's dedicated to enabling startup capabilities within the organization. That's outside of your traditional business owners because they have their day jobs to do, and this will fall to the wayside unless it's meaningful and you do it on purpose.
I would say that first customer relationship is one of the most important and critical pieces. So that's written into our contracts with our corporate partners that they must be a first customer. So bringing in revenue, but it's also their feedback that they're providing and data access that they're providing so that you can then go out into the broader market later. And that's when things like introductions come into play. But that commercial relationship is absolutely critical. That's what gets you started towards profitability too.
Question I had about organization of CVCs. So do most corporates, larger corporates, have a VC arm and as an organized effort, or what if they don't? What's the best way to go about it? And, I mean, how many large companies do you think you have those CVC arms, such as you guys, and what's the best way to go about with those that don't, for example?
Yeah, I'd be willing to bet that most of the Fortune 500 at this point have a CVC in some capacity. If you're starting one from scratch, how much time do you have? I think there's a lot of learning that's happened over the past decade of how we can do better. I think you have to understand the ecosystem, and I think you have to understand what venture capital is. So I think that's one part of building that team. I think you have to understand the organization as well. And many, many, many times, the people that do that are not the same. So the person who knows the organization is not the one who's going to know what it means to be a venture capitalist. So I think you have to have those two capabilities in a unit to like really be successful, because you don't want to get you don't not want to know the terminology and kind of the speed and like what's happening, et cetera. So you have to know the ecosystem, and then you have to get buy-in from the business. As far as like where it sits, CTO's office, strategy office, corp dev, that almost doesn't matter. But I think you have to have coverage at a high level to go do it, and you probably need 3.5 to 4 years to really show value, because I don't think that you're going to get the answers that you want specifically from a CVC in a shorter period of time. I think if you're building businesses, you can do it faster, but then you're not actually building that venture capability necessarily in-house. And I think that's just a different path to take. So if you want to build businesses, I think doing what Caitlin is doing is really important. If you actually want to think about investing in the future of like in companies, et cetera, I think you'll need those two capabilities. Where it ends up sitting, I think, is less relevant, and frankly, it'll change.
Yeah, I know we're out of time, but the only thing I would offer is investing. I think connotes having like tons of money that you're putting into all sorts of things. Start small. Our average check size is under $1 million for the deals that we've been doing. We're playing earlier stage, and we sit low on the cap table, but it's not a big dent for the balance sheet, and I think it also allows you to get proof of concept and start to move quickly. So it's not like you need to start out with a $250 million fund and all the bells and whistles.
And by the way, even if you have a $200 million fund, you're not that big.
Agreed.
You're not that big, right? So we pretend like we're a Fortune 500 company. Look at all the money. You don't have that much money. Sequoia has 10 billion. So stay in your lane, right?
Thank you guys so much. You've been fantastic. Appreciate the questions, and they'll be over here to speak more if you'd like.